We will call the Banking and Finance Committee to order for our hearing of March 11th, 2013. Welcome to those of you who have joined us this afternoon. As you may know, we're on a somewhat limited schedule since we're anticipating being back in session on the floor at about 3:45 to hear from the Chief Justice today for her State of the Judiciary. So we're going to get started here even in the absence of a few more members. Hopefully we'll have some come join us during the course of the hearing, but I do want to give a chance for those we've asked to come testify to be able to do so without being too truncated. So we'll get started. California is at the center of technological innovation and development. I think we're all both aware and proud of that fact. Our state is a wealth of knowledge and innovation, especially in our collective wisdom and our intellectual power that resides with those who lead the technological revolution in our state, in our nation, and indeed around the world. And in fact, the technology that emerges almost on a daily basis is rapidly changing the world around us as well. Among the developments in the financial services field, the way in which we send money, either for goods or services or to family and friends, is one of those areas that has been rapidly evolving. According to a survey by the Federal Reserve, 21% of mobile phone owners have used mobile banking in the last 12 months. 11% of those not currently using mobile banking think that they will probably use it within the next 12 months. The most common use of mobile banking is to check account balances or recent transactions, and transferring money between accounts is the second most common use of mobile banking. 21% of mobile payment users transferred money directly to another person's bank, credit card, or PayPal account. Interestingly, the underbanked make comparatively heavy use of both mobile banking and mobile payments, with 29% having used mobile banking and 17% having used mobile payments in the past 12 months. The U.S. mobile payments market is predicted to reach $90 billion by 2017. Traditional global remittance payments are expected to reach $534 billion by 2015, and the percentage of payments made using mobile technology is expected to increase year over year. In California, as in other states, the regulation of remittances and mobile payments falls under the Money Transmission Act, or MTA. The MTA regulates the non-bank foreign and domestic transfer of money and issuance of stored value. Licensees under the MTA must demonstrate appropriate financial capacity reserves for safety and soundness. The purpose of our hearing today is to give us an overview of the interaction between this law, the current MTA, and growing and changing technology. The ways in which we move money are complex, with an ecosystem made up of mobile payments, Internet applications, point-of-sale applications, SMS remittances, and traditional face-to-face transactions. I have introduced AB 786 as a bill designed to be a starting point to bring some common sense reforms to our money transmission laws, hopefully so that it will account for the changes in technology and ensure that we do not inhibit innovation even as we maintain appropriate and sufficient consumer protections. I look forward to working with the members of the committee, of interested parties and stakeholders as we move forward with considering how to best shape this legislation to accomplish the objectives that I've just enumerated. With that, I'll ask our Vice Chair if he has any comments he'd like to make before we go to our witnesses.
No, not a whole lot of comments, but it's good to be here. And got a lot on our agenda this year, a lot of complicated issues, and I'm sure we'll get through them. And so thank you for everything, Mr. Chair.
With that, we'll ask our first witness, Commissioner Barnes from the Department of Financial Institutions, if she would come forward and join us for whatever remarks she would like to make.
Thank you, Chairman Dickinson and Vice Chairman Morrell. And
good afternoon.
And given the truncated time that we have this afternoon, I am fine with simply starting with your questions and going from there.
That would be fine.
Any questions?
So let's start with how do you see the operations currently of the department with respect to regulating money transmissions? How is implementation of the MTA working in your view at this point?
Oh, thank you.
Maybe we should just back up a step. And for some, we have some new members and others who may not be so familiar with this area. So perhaps you might take a minute or two and explain what it is the department's doing with respect to the MTA's implementation, and then we could go from there to other questions.
Fine. The Money Transmission Act, what we call the MTA, was actually a combination of three different acts: the Traveler's Check Act, the Payment Instrument Law, and the Transmission of Money Abroad Law, were all brought together in 2010 in an effort by actually this committee to streamline the regulatory requirements that were put upon financial institutions, financial service providers that were doing money orders, traveler's checks, and money transmission. At the time, in 2010, we were only doing money transmission regulations on licensees that transmitted funds abroad. And the transmission of money abroad law had been in existence, from what I can gather, well over 60 years. So it wasn't a new law. What happened in 2010, and bringing these three laws together, is that in the interest of consumer protection, California decided to streamline the regulatory burden, because we had some companies that were required to get 3 different licenses, all regulated by the DFI. So if they issued money orders, traveler's checks, and payments abroad, it was considered a burden, and everyone could understand that they would consider it a burden to have 3 separate licenses with 3 separate types of examination process. So to bring those 3 laws together in 2010, with the understanding that while there was a need to streamline the law, the legislature also, as my understanding and looking at the legislative intent, wanted to maintain the protection of the consumer. And the DFI views the MTA as it is now enacted, and we are administering it as a Consumer Protection Act. With that in mind, we saw that in 2010, effective as of January 1st, 2011, the MTA now covers not only transmissions abroad, but also domestic transmission. It also now covers non-bank open-loop stored value, and by stored value, it's the cards or any medium where you can have value, money, use your credit card to, or the internet, to set aside value that the consumer can use to redeem products and services. The MTA made it clear and continued the concept that if the stored value was used like a Starbucks card, and Starbucks issued a card, a stored value card, and that consumer used that card only to purchase Starbucks products, that transactions, that activity would not be regulated. However, if the stored value was used to purchase other products and services from third parties, that would be regulated. And I think the easiest way to think about it, and the way we think about it as DFI, and recognize that we are the regulators for other institutions who hold other people's money in trust. We regulate banks, we regulate credit unions. And while it's not a deposit, we view the holding of other people's money as a trust. And the Money Transmission Act, we administer it in a manner to make sure that the institutions who have a license and who we regulate are operating in a safe and sound manner because they are holding consumer funds in trust. The MTA in 2010 expanded the safety and soundness licensing to keep pace with new technologies while at the same time continuing to protect the consumer. So technology and the internet was very much top of mind when this law was expanded to include domestic transmissions as well as internet fund transmissions. The question has been raised as to whether or not the MTA is working as intended. I strongly believe that the MTA is working as intended. I actually think that the fact that we're having a hearing today to talk about the MTA and how it's being applied and administered by DFI is one more indication that it is working as intended, because the bulk of the comments that we have received in understanding the MTA have come not from the licensees in the financial sector, but from the licensees in the technology sector and in the internet sector. And I want to be clear that DFI does not regulate technology. We don't regulate software. We don't regulate the internet. That our role and responsibilities as enumerated in the law, which as the Commissioner I'm tasked with implementing and enforcing, our role is to protect the consumer, ensure that the financial institutions who hold other people's money in trust do it in a safe and sound manner, that they not only have the capital that they need, but they also to start a business, but they also have the wherewithal to continue the business, that they will be in existence beyond the initial 3 years, that their management has the skills and the experience to protect these funds and to operate with policies and procedures that are safe and sound, and that they're following the law, that they're following not only California's laws, but the Bank Secrecy Act laws, the money laundering laws, and other similar laws that have come out of Washington as well as California to protect the consumer. So yes, is the MTA working as intended? It is. That being the case, there's still work that can be done. I am almost celebrating my 1-year anniversary with the Department of Financial Institutions as commissioner. And in January, in our January monthly bulletin, we announced that we will be issuing regulations to provide some clarity and information, because I think the folks who have questions about the Money Transmission Act are those who come from the technology side and from the internet side, and we intend to add some clarity to that process. Thank you.
So I'm glad you mentioned a question we had invited you here. Oh, thank you. I'm glad you answered the question about is the MTA working as intended from your point of view. And as you know, in the letter inviting you here this afternoon, we had a number of additional questions. So maybe we could just go through those, and then we will see if the committee members have other questions. So the next question is, how many entities are currently licensed under the MTA? How many are currently under consideration. Of those that have applied, how many licenses have been denied, and what were the reasons for denial?
Right. We currently have 23 entities that have MTA licenses. There are 20 applications that are under consideration. Of those who have applied, no one has been denied. Just to also give you some additional information, we've had 42 applications that have been filed since January 1, 2011. We have issued 26 new licenses since January 1, 2011. And we have advised over 20 entities that they are not, do not come under the Money Transmission Act. And a couple more statistics that might be helpful. When the MTA was being discussed in 2010, DFI at that time had expected, rightly or wrongly, expected about 5 to 7 applications a year. They did not expect 42 applications in the last 2 years. And so I think in addition to the 42 applications, they have had over 130, we have 73 licenses. What did I say, 70? We have 73 licenses. Yes, yes. I thought I had missed somebody. But we also have had 130 inquiries in the last 2 years, which far exceeds any inquiries in any other licenses that we have. And so that's why it's important to have both regulations and orders with respect to the Money Transmission Act to give clarity to how we are administering these laws, this law.
So you referred to 42 applications and 26 licenses granted. Was that in the last
2 years?
In the last 2 years.
Mm-hmm.
So, and no denials. Does that mean that there are 16 still under consideration?
There's actually 20, if my math isn't adding up. Some companies may have withdrawn their application. So in the process, the application process, we actually reach out to companies or companies that reach out to us. We have pre-filing meetings where we sit down with them to understand their business. We look at who has control of the funds, basically flow charts to follow the money. Where's the money? Who has the money? Whose name's on the money? And how do they control it? And there have been applications where we have determined in sitting down with the applicants that they actually are not in control of the money. Someone else is in control of the money. Someone who has a license is in control of the money. And so we have given them clarification that if they continue to operate in that manner, then they would not fall under the MTA. I think the other thing that has happened is there have been, as part of these pre-filing meetings, some companies in the process of their application may determine that it's better for them to work with another entity like a bank that we regulate in DFI so that they don't require a money transmission license. And so someone may either put their application on, I want to say pause. They might want to suspend their application for a period of time to see if they can partner with another licensed money transmitter, or they might decide to withdraw their application completely.
So is it then correct? There's somewhere between 16 and 20 in that neighborhood applications pending?
So actually pending, currently there are 20 under consideration.
Okay.
Yeah.
And can you describe for us the average length of time it takes to get an application through the process, recognizing in some instances that, as you just described, people will suspend their application for one reason or another?
Right. Our internal performance goal is to process applications within 120 days. We actually average around between, I would say, average 95 days to process. But bear in mind that if we are talking to an applicant and they ask us to, if we ask for additional information or they're in merger discussions, they'll ask us to suspend their application until they come back to us. But while it is an active process and it's not been suspended, it takes on average, I would say 95 days, between 92 and 96 days.
So except for those that may be in some state of suspension at the initiation of the applicant, for the applications that are currently under consideration, we could conclude that those were filed sometime within the last 4 to 5 months?
No. Some have been filed within the last 4 to 5 months, and some have been longer.
95 days roughly for processing.
Right, 95 days for processing. And we also, there are times when we ask for additional information. So, for example, if we're talking to an applicant and we're trying to determine their source of capital, their source of strength, and they have a parent company and they've provided us with information about the money, the applicant, but not necessarily their parent, or there's an additional source of capital for them, we may ask for additional information from them on that. And during that period, they may ask us to suspend the application while they gather that information for us.
Some have said that they feel the barriers to getting approval are too steep. The bonding and some of the other requirements, especially if they are smaller volume, intend to operate on a smaller volume, dollar volume, in their money transmission work. Have you seen anything and made any observations that would allow you to comment on that concern that's been raised?
Money transmitters who are applying for a license are asking the state, now that we're regulating them, to be allowed to hold other people's money. Lots of money. We're talking hundreds of thousands into the billions of dollars of other people's money for some period of time. Some of them hold them for a couple of days. Some of them hold them for months. Some of them can hold them for much longer periods of time. I view the holding of other people's monies in the same vein as I view holding bank deposits and credit union deposits. The criteria that is in the MTA in terms of fees has been in existence for money transmitters who transmitted monies abroad since 1989. These are the same fee schedules since 1989. The capital requirements are actually less than the capital requirements that we would insist on for a de novo bank or a de novo credit union. The MTA lists some 20-odd items that, as commissioner, I'm required to consider. And I believe that the MTA's list of items to be considered, as well as what I'm supposed to determine, is again there to protect the consumer. Each of these provisions is to protect the consumer. I would hope that applicants, even if there weren't a Money Transmission Act, that they would understand that the business that they are going into is a very serious business when you're holding other people's money in trust, and that you should have adequate capital to weather a storm. You should have adequate reserves to protect your customers if there should be some difficulties in your financial condition. So I don't think of it in terms of whether it's a barrier to entry. I think of it in terms of, are these protections for the consumer appropriate? They were appropriate since for over 60 years for the money transmitters who were transmitting it abroad. They're similar to the provisions that protect consumers at banks, and they're similar to the provisions that protect the members of credit union. So I don't think they're barriers to entry. I think they're consumer protections.
Okay, thank you. Mr. Sajian?
Thank you, Mr. Chair. A question on holding on to somebody else's money. I can see why they shouldn't hold on to somebody else's money for longer than maybe the hours or the few days it requires to clear a check. If you were to deposit a check, large check with me, regardless of the amount, and if you don't have a working relationship with a given bank, in other words, they don't know of your background, they probably want to hold on to that amount till the check clears the other side before they release the cash. I see that make good business sense if it's done properly for the duration that it takes to clear a check. Even if you were to deposit a check in a savings account and you're able to collect interest from the moment you deposit, which is great, but if you were to take money out, they probably say not for 24 hours or 70 hours, just to be sure that the check is going to clear the other bank, that the person did have checks. Otherwise, anybody can come and deposit a check, then turn around and write a check on that money knowing that it's going to bounce or it's a fraud. So when you come up with regulations, what are you taking into consideration, not just to protect the consumer, but also protect those who are in the business of serving the consumer?
First and foremost, I'm going to be thinking about the consumer. I'm also going to be thinking about the safety and soundness of the financial service company. And so in looking at the regulation, we'll be looking at whether they're in good funds. I think that's where your question is going. I'm not going to want to put the financial services company at risk for if the funds aren't available. But in our regulations of and supervision of money transmitters, that's really not been an issue. More of an issue has been last week we received a complaint from a lawyer whose client is an employer who the employer company is in California, and the employer hired a payroll processing company outside of the state of California to do their payroll. And the payroll process, let's say non-California payroll processing company, was doing payroll for a California company, and they were supposed to take the funds from the employer and then write checks to the employer's employees, and also do the withholding and pay the federal and state taxes. And this non-California payroll processing company did not make the payroll for the employer, did not pay the taxes or do the withholding, and as a consequence, both protecting the employer, who now has to still have that liability to the taxes and still has the liability to their employees, has to make up those funds. And if we were regulating that out-of-state California, and we're looking into whether or not they should have applied for a license, if we were regulating that company, we would be looking at their processes and policies and procedures for how they take monies and how they distribute the monies in accordance with the instructions and the contracts that they have with their customer, which is the employer.
That's something I'm with you. I have no problem there. The companies who are outside California, are they required to be bonded?
Well, they're required to be licensed. If there was, we're still looking into this, it just came in, but let's say hypothetically, they did take the money from the California company, the employer, and they did have control of those funds. They, under the MTA, should have been licensed. We should be looking at them from a safety and soundness perspective, which would have, are they going to continue to exist in California and operate in a safe and sound manner, which deals with your question about making sure they have good funds before they let the funds released? And also, are they in compliance with the consumer protection laws in the state of California, as well as other consumer protection laws, as well as bank secrecy and money laundering?
And I'm all with you that all these should apply for outside or even inside California, that they do comply with California laws, that they are licensed and insured. In case they go bankrupt, we don't want people who are payroll depends on that they're gone down the wire like the company has.
Right. In California, there's not insurance like FDIC insurance or for credit unions, NCUA insurance, but there's in the MTA and had been in the MTA because of our formal laws with money transmission abroad, the concept of eligible securities. And money transmitters, even before 2011 in California, are required to maintain eligible securities, which is effectively liquidity and also protection for the consumer. If the money transmitter were to go into bankruptcy, that there should be eligible securities equal to 100% of their money transmissions and stored value in the United States. And so that is what I consider the functional equivalent of the FDIC insurance or NCUA insurance. So that's why it's also important to have money transmitters licensed in California so that we can give assurances and regulate that they are in compliance with the eligible security requirements as well as the bonding requirements.
Okay. Mr. Chow?
Thank you. Yes, I have two questions. First of all, this is a follow-up to my colleague's question. So all licensees, whether out of state or not, are required to post a surety bond in sort or no? Or do they need to have enough assets to cover the amount of the money being transferred?
Yes,
So
all licensees have an eligibility requirement. And the question is, if they operate completely outside of California, so they're in another state,
Right.
They're in Hawaii, they only deal with consumers in Hawaii, they have no transmissions in California, we do not license them. But all licensees, money transmission licensees in California are required to maintain eligible securities equal to 100%
of the money being transferred.
Right.
So then that number fluctuates depending on what the amount of the funds being transferred.
Yes, it can fluctuate. Yes.
I see. Now, second question, just to follow up on your opening remarks, you said that the MTA is operating as intended, yet there is room for improvement. Essentially, that's what you said. And I think the chair posed one question in reference to the application process. So I think that application process could be streamlined, probably. But besides that issue, what other issues do you see that we need to look into? For example, how do we improve the system a little bit more?
Okay. Well, first, I want to be clear that in adding clarity to the MTA, I believe the orders and regulations that we're going to be issuing will add clarity and help to improve the process. But I have to tell you, I think the law as written today is very important because that all those items that have been listed to be considered, I think are very, very important for whoever is regulating money transmitters, whoever is holding other people's money, whoever is effectively holding a deposit of somebody else's money. All of those items that are listed are really, I wouldn't necessarily streamline that, except to the extent we determine, I would keep them on the books, keep them in the law, but clarify in the regulations that, for example, if we were to identify a money transmitter that I would say is low risk, like they have only one product and one geographic, they don't do anything internationally, it's really simple, they don't take cash. In looking at everything listed in the MTA to be considered by DFI, what already the MTA already allows the commissioner to take all of those things into consideration and look at the quality of the management, the assets, and the source of strength for the applicant. But I would not want to take any of these tools away to say that you don't have to send financial statements for the last 3 years. We would want to be able to look at the quality of the earnings. You know, are there any balance sheet issues? Those protections, I would say, need to remain. By the same token, we can give some clarity from a regulatory perspective as to how we look at all of these items.
So then,
because we don't treat every applicant, it's really an art form in the sense that we don't treat every applicant exactly the same. So a money transmitter that's been operating in 35 states that comes to us, you know, we're going to be able, and they're being examined by other states, we're going to have the benefit of those prior examinations. We work with other states in developing joint exams and joint protocols. So we have the flexibility to be able to look at that money transmitter, go down the list, but how we get comfort on all of these items may be a different way. It may be that we're getting comfort from from some of their other examinations. But I think all of these indicia of risk, all of these areas are important to consider to protect the consumer. And I would ask that if there are amendments to the Money Transmission Act, which is certainly within your purview to do, and you did in 2010, that we don't do anything that's going to harm the consumer.
Sure.
Do you have one more follow-up?
Just one quick. I'm sorry. How do we, the state of California, stack up against other states in terms of procedures or otherwise, or whether or not are we more stringent than other states, or are we just about on the average, just similar to other states?
We were we were the last state really to come in 2010 to the party of regulating. I think we provide greater protection for our consumers. I know that there are some money transmitters that are startups that decided to go to other states to start their business, or they've decided to work with money transmitters that are already licensed here. I think we may protect our consumers better than some other states. I haven't done a state-by-state comparison. I did see the 50-state analysis. But I would also caution that California has more money transmissions than any other state in the union. In fact, the next 3 states under California in terms of money transmission don't add up to how many money transmissions that we have in the state. And so I think for those reasons, it is important to maintain that while we may be different from others, our sister states, in how we regulate money transmissions, there's a reason for that difference, and that being a state where technology innovation is key, and where technology and innovation is going to be developed in a manner that's going to make it easier and better for consumers to put funds in the hands of other people, I think that's a good thing. I encourage it. I want to be able to use those technologies myself, but I also want to be sure that California continues to protect the consumer.
One last thing. Have you seen instances where an application hasn't been pursued or has been stymied by the necessity of obtaining the bonds and the securities that we've been talking about, and yet it's difficult to get them because a license hasn't been issued? It's a chicken and egg issue. Have you seen any of that in the applications?
We have a lawsuit before, so I can't say I haven't seen it. We have been sued by an individual, a company, who have made those and similar assertions. I'm not at liberty to really discuss that. If this committee would be interested in having a better understanding of DFI's response to those types of statements and allegations, we can share with you our briefs. We are being represented by the Attorney General's office, and I think the briefs might be able to give you better guidance in that regard.
I think we would be interested in that. Thank you, Commissioner.
Thank you.
I appreciate your comments this afternoon. And now we will turn to our panel, and if you could please come forward. First, we have Thomas Brown, who's a lecturer at the UC Berkeley Law School and a partner in Paul Hastings, LLP. John Mueller, Vice President and General Counsel of PayPal Incorporated. Michelle June, Senior Attorney, Consumers Union, or Yoon, I'm not sure. Is it? John, okay. Rob Barnett, Vice President, Assistant General Counsel at Automatic Data Processing Incorporated. And thank you for being with us this afternoon. And in light of our time, if you could try to keep your opening remarks to about 5 minutes, then that'll give the committee members time to delve into the issues with you. And if it's agreeable to you, we could just go in the order that I introduced each of you. So, Mr. Brown, you'd be first.
Thank you, Chairman Dickinson and members of the committee. It's an honor to be here to talk about a subject that tends not to get the same level of attention on an annual basis as the business of moving money from place to place. There's something about the ability to engage directly with financial services via an iPad or an iPhone or another instrument of mobile technology that seems to get people excited, and I think helps to explain some of the reason why we're all here. I've provided written testimony to the committee and am open to taking questions on anything that I addressed there. With my oral remarks, I wanted to make a couple of very short points and then save time to take questions. So the first is that the consumer financial services industry, both in the state of California and the United States, is appropriately a highly regulated business. And the set of statutes that govern this business include things like the Truth in Lending Act, the Electronic Funds Transfer Act. In the state of California, we, of course, have the Money Transmission Act. And the consumers' interests in interacting with financial services are largely met through those traditional consumer protection statutes. There are a separate set of requirements for industry participants that are interested in being in this business, and those relate to the primary reason that we're here and are reflected in things like the California Money Transmission Act. And those are the issues that fall under the general heading of safety and soundness. How much money do you need to have in order to support the activity associated with your program? So both Assemblymember Acadian and Assemblymember Chow asked a question about capitalization requirements with respect to businesses that are interested in moving money from one consumer to another. And the answer, just to embellish a little bit on what Commissioner Barnes offered, is they're actually threefold in California. So one is if I receive money to transmit it to another, I am required to hold eligible securities that back those funds on a dollar-for-dollar basis. So that distinguishes the money transmission business from the banking business. So the banking business, we sometimes talk about fractional deposits, right? So for each dollar of volume that the bank is holding, they need to hold some fraction of that in eligible securities. So if you were in the money transmission business, to be clear, right, a business that we theoretically think of as less regulated, you are required to hold $1 in eligible securities for every dollar of float volume. So that's one element of the capital requirement. You're also then required to meet a certain threshold of capitalization. So the statute sets the minimum threshold as $500,000. As a practical matter in California, that threshold is the minimum is $2 million, as a practical matter, it's $2 million. Then the third is that you're then on top of both the capitalization requirements, so the equity on your balance sheet, in addition, of course, to having that one-to-one dollar backing of every volume in the system, you're then required to post a bond, right? This is an extraordinary amount of safety and soundness for a business that at the end of the day is not all that complicated, one. And then two, one of the themes that I sort of laid out in my testimony was that even though I obtain a license in California, to the extent that I seek to offer that service on a nationwide basis, I then have to get a license in each state. And some of you may have seen the survey that I put together of the handy Bible of state licensing requirements. You're required to obtain a license in each of the states in which you do business. And I believe that that is an onerous load of regulation on the safety and soundness side, and as the Commissioner articulated in her remarks, has suppressed innovation both here in the state of California and around the country. It makes it more difficult to achieve the electronification of payments, which is something that I think all of us in California have an interest in facilitating. So those are the points that I wanted to articulate, and I'm happy to take any questions.
Thank you. We'll turn to Mr. Mueller. Thank you.
Thank you, Chairman, and thank you to the other members of the committee for the opportunity to testify. My name is John Mueller, and I'm the Vice President and General Counsel at PayPal, a California company based in San Jose and part of the eBay family of companies. We've been in business since 1999, and we've been regulated under the Money Transmission Act and its predecessor since 2002, so more than 10 years now. And that is part of a decision we made fairly early on in the company's history about the company's business model and really our attempt to follow customer demand. The company started with the hot mobile device of its time, which was the Palm Pilot, and an assumption in 1999 that soon most people would own Palm Pilots and they would all want to send each other money through the Palm Pilot. We quickly learned from customer demand that that wasn't the case, but that there was an interest in people using the internet and email, which were much more widely distributed, as the method for sending each other money. And then we quickly learned that, in fact, most people wanted to use this new payment method not just to send each other money in a traditional type of remittance, but to buy things, to buy goods and services, first on the eBay marketplace, which is how we wound up as part of the eBay company, and then eventually with small businesses and larger businesses all over the country starting to operate their own websites. And as part of that, we had to decide, will we follow the traditional payment processing model in place at the time, and still to a large extent today, where the customer gives their financial information to the merchant, and then the merchant sends it through the payment processing system, usually the card networks? Or would we have the consumer shop without sharing, as we call it. So shop without having to share their financial information with the merchant and only share it with PayPal as the trusted intermediary. That's what we decided to do. In that context, it's really the consumer who is pushing the money through the system rather than the merchant who's pulling the money. And so at that point, it starts to look more like a traditional remittance. And as a result, we did get our license back in 2002, as I mentioned. So the license has not inhibited our growth overall. We have grown over those 10 years to a point where last year we processed worldwide approximately 165 billion in transmissions. Again, almost all of that for the purchase of goods and services or charitable donations. We have overall had a good relationship with the Department of Financial Institutions under the Act and its predecessor. We haven't necessarily agreed on every point of interpretation, but we have had an open relationship. And so I think our perspective is similar to the Commissioners. There are some opportunities for improvement. In particular, there are some elements of the Act that are still based on the traditional remittance world of cash-based transactions or of transactions where there is a delay between the sending of the money and the receipt of the payment by the recipient, whereas in our case and the case of other recent technology payments entrants, in most cases the receipt of the money by the recipient, usually a seller, is immediate. So we think there are opportunities for improvement, but it is an act that we've been able to operate under successfully for these years, and I'll leave it at that in the interest of time, and thank you.
Okay, thank you. I'm sure we'll come back to you about what those areas of improvement are that you see. Ms. Jung.
Good afternoon. My name is Michelle Junn, and I'm a senior attorney with Consumers Union, the policy and advocacy arm of Consumer Reports, whose mission is to work towards a fair, just, and safe marketplace for all consumers and to empower consumers to protect themselves. We thank the committee and the commissioner in putting on this hearing today that's focused on the Money Transmission Act. The MTA provides individual consumers with greater assurance that the companies who they entrust in to transfer their money are not fly-by-night operations. There is no federal law which provides for this type of oversight. Thus, it is important that the focus of this hearing is on protecting consumers in our state who use and often rely on money transmission services. Section 2002 of the California Financial Code, or the preamble to the MTA, states this purpose of the law, which is to protect the interests of persons in this state who use money transmission services. It is clear that the legislature intended that the MTA is for consumer protection. We stress that this committee must continue to maintain this focus as it explores the MTA, particularly in light of the many consumers who rely on money transmission services, as they either cannot or do not want to utilize mainstream financial services. A weak money transmission law, or the lack of a money transmission law, would most certainly have disparative impact on the more financially vulnerable populations, including communities of color, immigrants, the unbanked and underbanked. In reference to an FDIC report, underbanked populations include about 43 million adults and 21 million households. These households use non-bank money orders or non-bank check cashing services, payday loan institutions, rent-to-own agreements, or pawn shops on a regular basis. Blacks, Hispanics, and Native Americans are the most likely Americans to be underbanked. Additionally, the manner in which consumers use money transmission services has changed substantially, where they may be subject to losing more money than they had before if they conducted their business with a less than stable or trustworthy company. In the past, money transmission services were single transactions, such as with a traveler's check or international money transfers. With the advent of electronic payments, there is a greater potential for consumers to lose more money as they utilize payment instruments such as prepaid and payroll cards. Further, this growth in alternative financial services is projected to grow enormously with wider and the expected universal adoption of mobile payments. Compliance with the MTA is necessary in shoring up public confidence, which benefits the larger marketplace. Without public confidence in money transmission services, consumers who do not need to use a less secure payment method are less likely to use the latest alternative payment method. Why would a consumer decide to use a payment method in which they are uncertain about the solvency or the general credibility of the company behind it over pulling out an existing credit or debit card? We are not the only skeptics. An IBM executive quoted in a recent San Francisco Chronicle article stated, "You have to offer them a compelling reason to use mobile payments. At a very, very minimum, it has to be just as convenient, just as broadly accepted, and just as safe." Consumers Union encourages this committee and others to make sure that the MTA continues to best protect consumers who make money transmission services. While we certainly want to see the continuation of payments innovation, we believe that protecting consumers' money always takes precedence, particularly for the most financially vulnerable. For many consumers who use money transmission services, they do not use them for the novelty of making a new way to pay, but rather rely on the money transmission services to send money to loved ones or to pay bills. Technologies will come and go, but making sure that people's hard-earned money is safe should always be and remain the focus of the MTA. Thank you.
Thank you for those comments. We appreciate that. Mr. Barnett, hitting cleanup.
Thank you, Chair.
Welcome.
Thank you, Chairman Dickinson and other members of the committee for the opportunity to present this afternoon. I'm here actually in somewhat of a dual capacity. I'm here on behalf of the National Payroll Reporting Consortium, who actually comprises probably, I think, 11 or 12 of the top payroll service providers in the country. So a very large group providing payroll type benefits, payroll services, and other payroll related services to over 1.5 million employers across the country. I'm also here in my capacity as Assistant General Counsel and Vice President for our ADP, Automatic Data Processing. And obviously ADP, everyone knows, does payroll, but ADP also does a host of other activities that include money transmission type activities. And I think one of the points that I'd just like to make as part of the opening remarks is that one of the things that I've heard very clearly here, and even Commissioner Barnes pointed out, the purpose and intent of the statute itself was consumer protection. And whether intentional or not, the impact in reality is that it goes much beyond just simple consumer protection. Certainly you can define consumer as very broad, or you can actually look at it as individuals or services to individuals as opposed to services to other corporations or businesses, which most service providers in the payroll space obviously are providing services to employers, not to individuals. And I think, from our perspective, obviously there are a lot of payroll laws that regulate wage payments and whatnot, and certainly there are federal laws that regulate through the IRS and other laws, the payment of tax payments and that type of activity. But one of the issues, or one of the challenges that we faced, is given the very broad nature of the definition of money transmission, it essentially picks up any and all activity. Basically, you take money from one party on behalf of that party, and then with instructions to transmit it to another, and you're considered a money transmitter. And the effect of that is that you end up regulating a vast number of business-to-business transactions, which, from the basis of the statute and the intent expressed in the statute, was really more of a consumer protection statute, not one to regulate business activity. Certainly not here necessarily to argue whether it should apply or not apply to businesses generally, but I think one of the challenges that we've had in dealing with the Department of Financial Institutions, who, in our case, has been outstanding. They work with us very closely in trying to address and deal with some of the challenges that we've had. So we certainly have no issues with the DFI, and certainly appreciate their partnership. But one of the challenges is around the fact that this statute, as previously mentioned, was really drafted with the mechanics for over-the-counter cash-based money transmission, which in our case, we don't take cash. Everything that we do is bank-to-bank, essentially. And so the mechanics of the statute are designed such that they really require things like receipts and rights to refunds and things that make perfect sense in the context of a consumer transaction, but do not necessarily make as much sense in the context of business-to-business transactions. And it's created a significant challenge for us. ADP, obviously, we have resources. That's not the issue. And we certainly are very seriously committed to our compliance with laws and doing the things that we need to do to protect, the value of the services that we provide to our clients. And we take our role as a transmitter of money and holder of other people's money quite seriously. We've been in this business for well over 60 years and have weathered a lot of storms and been able to get through a lot of things that a lot of people haven't. But one of the issues for us is trying to comply with some of these technical requirements in the statute that are really designed for over-the-counter money transmission. It makes it difficult because obviously, for example, we do the receipt requirement. We have over 600,000 clients across the country that we do all types of money movement activities for. And delivering a receipt to someone when you're doing a bank-to-bank transfer that's pre-authorized in an agreement. We have agreements with all of our clients that govern the relationship and identify how it is and when it is we can take money. Having to deliver a receipt in connection with that is a challenge. It's not impossible, but certainly a challenge, and one that most payroll providers aren't set up to do in an electronic world, once again, because we're just not taking cash. And some of the other requirements, right to refund language. Once again, we have contracts that govern exactly when it is that we are to deliver the money to whom and under what circumstances. And so under the statute, you're required essentially to tell people they have the right to refund within 10 days. And in an over-the-counter transaction, that makes sense. But in the context of a business-to-business transaction, it's much more of a challenge. It makes less sense in that context. And then there's just other things like consumer notices. You're required to put signs out giving consumers notice of their rights. And once again, we don't even have facilities where individual consumers can walk in and buy our services, right? We have sales forces that deal directly with people. So I think one of the challenges and one of the things that we see as an opportunity within this statute is potentially looking at the definition of money transmission and figuring out and deciding whether or not that was really the intent to have it be applied so broadly to so many people. Certainly on behalf of the payroll consortium, most of those folks in that group don't feel that it was necessarily intended to apply to them. But we're here, and ADP, we've applied for a license, and we've been working through that process. But essentially, at some point we have to figure out whether or not was that the intent or not the intent. And if it was, then maybe there just needs to be some tweaks to the mechanics to address some of these other issues. I would also offer up that there are a host of other businesses that I'm just not sure were necessarily intended to be covered by this. Accounts payable businesses, COBRA, tax credit services. These are all things that, although sort of are related to payroll, are actually provided by a lot of people that don't even do payroll. They might do these types of services separate, wholly apart from actual payroll type providing services. And so I think it really brings in a very vast and a wide group of businesses that are potentially regulated. And, in this environment, obviously more regulation, it's difficult in the state given the resources. So it's our feeling that it just needs to be maybe looked at and decide whether or not if that was the intent and that's the direction it wants to go, then mechanically it really needs to work in that context. Thank you.
Thank you for the comments, all four of you. And let me let's start where we ended, because I'd like to explore this just a little bit more with you, Mr. Burnett. Is it your view that payroll processors in particular ought not to be seen as money transmitters in the sense of the statute, or would you advocate that business-to-business transactions in general be treated differently than under the Money Transmission Act, or something else, or a third?
Yeah, once again, I'm not necessarily here to argue that it should not be regulated necessarily. I can only look at the law as it's written and the legislative intent and what seems to be the intent at the time it was drafted, and the intended purpose, which was really governing over the counter money transmission activities, right? The traditional Western Union type activities. I think obviously there's a lot of folks here that are being affected by the fact that it's very broad, but I would think that payroll providers are certainly companies and sophisticated companies and business-to-business type transactions. They should be sufficient. Not all are sufficiently sophisticated enough to necessarily protect themselves, but they aren't individual consumers for the most part. And so, the intent of providing consumer protection, unless you take a very broad read of consumer, I think the statute, the way it's drafted, and the broad nature of it, goes well beyond that intent.
I assume you would grant the point that there are small businesses and maybe even sometimes large businesses that aren't necessarily all that sophisticated or aware of what their exposure may be, such as contracting with a payroll processor or an entity to take care of paying the taxes, those kinds of things, and they may be at risk of fraud or misrepresentation in those transactions. We had a very controversial and visible case of that involving Sacramento County just a couple of years ago, which is not an unsophisticated organization. I can tell you that from firsthand experience, and yet fell victim to using a firm in another state that literally robbed the county. That's tax money, and it wasn't discovered until the IRS found that some things didn't reconcile and brought it to the attention of the county. So. You wouldn't necessarily exclude businesses from needing some form of protection. You're just arguing that maybe the notion of the traditional consumer in that context is not that broad. Is that fair to say?
That is fair. I mean, unfortunately, right, there are bad apples in every industry. I'm not
right.
here to say that payroll providers are all great, and I would think that the 11 or so that are part of the consortium, we like to think that we're above that type of activity. But certainly, there's needs to regulate at different levels across all businesses. So yeah, I would agree. I think the challenge for us really is the mechanics of the statute, right? Is this, if the intent is to regulate all activities, is this the right mechanical structure for that? And as I pointed out earlier, the commissioner and her staff and the DFI have been very cooperative in trying to work with us, but they, at times I think have felt as though there are some constraints with what they can and can't do because of what's in the statute. And so I think for us, the biggest challenge is just sort of conforming to the mechanical natures of the statute. So I'm not necessarily going to argue that there shouldn't be regulation. I think there are, as I pointed out, other areas in the law that do provide protection. As the commissioner pointed out, I mean, there was an unfortunate circumstance that they're now aware of, and that does happen from time to time. But that sort of activity would also fall under, IRS examination. There would be other places where there could be protections for businesses like that, maybe apart from the MTA itself.
Okay. Mr. Sajjan, did you want to follow up on this? Oh.
I had a question, but it got answered through the conversation, so thank you.
Okay, thank you. Mr. Brown, I wanted to come back to you, and I neglected to say this the first time around, but go Bears.
Indeed.
You did give us in your written submission some suggestions. Oh, I'm sorry, Mr. Miranda, just one thing that occurred to me. Is ADP licensed as a money transmitter in other states?
Yes, we are. We currently have 46 applications and 2 that are pending, one with California and one with Rhode Island.
Okay, so there's not enough deviation from state to state that you haven't sought a license in essentially all the states that are regulating.
That's fair. I think there was a question earlier to the commissioner maybe as to whether or not the laws are applied. I mean, there are 27 states or so that have laws very similar to California, and our sense is that having had conversations with other states as part of the licensing process, my sense is that a lot of the states, or some portion of the states, do not look at it as broadly as California does. I think as part of our conversation with the DFI, they've made it pretty clear that there really is no concept of unregulated money movement in California. And in other states, even though the statutes are relatively similar, for whatever reason, some of those states have chosen to regulate some activities like, stored value, for example, sale of checks, that type of activity that under a lot of statutes is actually enumerated, but other types of activities they haven't had an interest in necessarily regulating. So I wouldn't say that it's necessarily, it's just, maybe it's the interpretation, maybe it's resources, I'm not sure what it is, but I think California takes a much broader interpretation of the definition of money transmission, and it's based upon the statute. It's not unfair. It's a fair reading of the statute because it is very broad.
Mm-hmm. Okay. I'm sorry, Mr. Brown, I wanted to come back to you. One of your suggestions was some type of reciprocity be granted by California to other states. I'm assuming that you would apply some standard to that, and I'm not quite sure how it's articulated, but to ensure that we're not granting reciprocity in cases where we thought another state statute was less protective of consumers than California's.
So I think any
proposal on reciprocity is going to need to recognize California's interest in maintaining some assurance with respect to safety and soundness criteria, though I really do think that it is helpful to distinguish between consumer protection and safety and soundness. We can make arguments that safety and soundness requirements ultimately protect consumers, but that is not the primary objective of a safety and soundness requirement. The safety and soundness requirement does two things. It preserves the institutional integrity, and it serves a bit of a barrier to entry, right? I mean, so things that go to protecting safety and soundness are by design designed to filter out certain institutions. So that's sort of one. Only secondarily do they protect consumers' interests, and then not always. But we can come back to that issue as well. I do think, echoing the earlier remarks about the definition of money transmission and how that standard is interpreted in California, there is some cleanup work that can be done with respect to the MTA. As I pointed out in the written submission, the definition under the existing act is circular. If you actually trace through the definitions, money transmission is ultimately defined as money transmission. I would tell my students that we can hope for better in drafting statutory text. So at a high level, but then there's a more particular area of disagreement between California and other states, and that's with respect to this issue of the payee agent. I mean, at an abstract level, we should all recognize everybody receives money from some people and gives it to others. Like, that happens a lot at my house. I have 2 teenage girls, and there's a lot of receiving money and giving it to others. But then traditional businesses also receive money and give it to others. I happen to be a partner at a law firm. We receive money from clients and we pay it out to associates and staff, and then ultimately to ourselves. And we don't necessarily think of that act as triggering some sort of special case regulation, even though we're sort of holding other people's money at some level. And so I do think that we can be more precise as to what money transmission actually means, right? So when money is in float or not at rest, maybe that's what money transmission means. But when I'm giving money to somebody who is the agent has been appointed by the person to whom that money is ultimately owed as their agent, that seems like not so much money transmission. And at least 2 states have explicitly recognized that, New York, and it's then built into a couple of state statutes. So I do think that's another area where the committee can look, and to help relieve some of the pressure on DFI, particularly as we start to see financial services combined with other services through mobile technologies. One of my favorite sort of quasi-payment applications is Uber. I don't know if anybody has ever used it, right? It's gotten a little of attention for other reasons. But I don't necessarily think of Uber as a payment app, right? Getting in a cab, it's helped me locate the cab, and then I get out of the cab. And then there's money movement associated with that application, but I don't think of Uber as a payment provider, though there's some ways of looking at the statute that might subject them to that.
So let's pause on that, because maybe that's a fruitful area for illustrating this. I mean, I've not used Uber, but what I've read, it suggests that you contact Uber and you let Uber know your location. Uber contacts a taxi or
a town car or whatever.
Town car, and directs it to your location. But there's no transfer of money in that, to my knowledge. I mean, but maybe you can expand.
So what happens with many transactions of that archetype, and there are many, and it's not just Uber that uses that same basic structure, is when I get out of the town car, it will trigger a charge to the payment credentials that I have on file with that service provider, and it will then also trigger another transaction to that service provider. Now, I believe in Uber's case, they are the agent of payee for the people who have contracted with Uber to help them find customers. But so that gives an example. But there are many, many, many others. I mean, many electronic downloads are delivered through things that look like marketplaces, right? Where I go on, say, iTunes and download a Taylor Swift song, right? So it turns out Taylor Swift gets paid, and I pay somebody, and I'm paying one person, and that same person is then paying Taylor Swift. But again, that doesn't have the feel of a traditional transaction at, say, Western Union, where I go up to a counter, I give somebody money, and I ask them to send it halfway around the world, even though Taylor Swift may, for all I know, be in London right now. But so this gets at the difference between money transmission and other types of transactions.
I believe to be part of their organization, you have an account established. So when you call and they send you a cab or whoever they have a contract with, they're reaching out your account and withdraw that money and pay the cab company and they keep their percentage, whatever that might be.
Correct. But for when you get out of the cab,
already paid for.
But your obligation to the driver, this is, I think, the key distinction, right? Your obligation to the driver is released. Even if that intermediary fails to deliver funds to the driver, you as the consumer are protected as a matter of contract in that case, though there are federal overlays that are important here, too. I mentioned the Electronic Funds Transfer Act and Regulation Z earlier. Your obligation to the driver is satisfied by your successful payment to the intermediary, in this case Uber. And for me, that sort of breaks the money transmission chain, even though funds are ultimately being delivered to the driver.
Just to follow up my question to the Commissioner, if you go to a Western Union and let's say I want to transfer money to you in another part of the area, and I write a check, if they don't have a guarantee that that check will clear, don't they have the right to hold on to it for whatever the new technology allows them to clear that check? That's where I was.
That's where your question was going.
My question was going is, are we going to regulate both sides so there's a balance, or
right.
in support of consumer, then we're penalizing the
business provider? That's an excellent point, and not one that I had. Not one that I've given sort of a lot of thought to, but it does go to one of the sort of fundamental challenges of operating in these businesses, as Mr. Mueller can attest, right, is that consumers will engage in transactions with you and present themselves as though they have funds and then turn out not to. And then frequently you have an obligation to pay the recipient of those funds independent of whether the consumer actually has the funds. And that is the fundamental risk that you as the intermediary take on. And so your point about receiving a check that may not be good is an excellent one.
Because if it was to happen on a weekend when my bank is closed and I wrote the cash to forward it to you, I want to write a check, Western Union is open around the clock, then there is a problem. Unless we address it early on.
Yes.
I thought and I want to make sure I heard you correctly. I thought you made a remark to the effect of the safeness and soundness evaluation or criteria can operate as a barrier to entry, and in a way that's not necessarily protective of consumers. Is that the essence of what you said?
That's a fair statement. There are also some examples of instances where things that we think of as benefiting consumers via safety and soundness have actually worked against that interest. And I'll use one example. There's an interesting paper that's been published on this, that when you trace the evolution of deposit insurance in the United States, it turns out that state-mandated deposit insurance tended to make banks less safe on average, controlling for all other factors, because it reduces a dimension along which banks are then competing for the attention of consumers, which is not an argument against deposit insurance. It's just a recognition that things that we do, however well-intentioned, can have unintended consequences that work against the benefit that we're trying to implement. So this particular study looked at developments in state laws at the turn of the century around branch banking and deposit insurance, which were two progressive innovations designed to help ensure the safety and soundness of the financial institutions. Right, one by allowing some diversification, the other by ensuring deposits. Turned out branch banking tended to make banks made them safer because they could be in more geographic areas, and deposit insurance tended to make them less safe. So that's one. Then, but more generally, right, safety and soundness criteria do serve as a barrier to entry. I mean, if I need, as a potential innovator, an entrepreneur who wants to offer a new mobile payment application on an iPad, right? If I need to go to DFI and spend either 120 days or in some cases several years sort of working with the commissioner and staff to have my application approved, right, that necessarily slows down the degree to which people are introducing applications. Now, we might think that that's a trade-off worth making, but it is definitely a trade-off. And the higher we make the capitalization requirements and the more that we assess fees, we can expect that there's going to be less entry. People will choose to spend their entrepreneurial energies elsewhere.
So sometimes you want to prevent people from entering the market because they shouldn't be in the market.
Yes.
Other times, barriers to entry can operate as an economic device that gives some an advantage to the disadvantage of others. Do you have a point of view about how the California statute operates in that respect?
I do, and my point of view here is sort of informed by a little bit of history and the evolution of the statute. For me, PayPal is actually a fascinating case, right? So for PayPal, a money transmission license was an alternative to a claim that they were, at least this is the story that I have learned over time. Again, Mr. Mueller can embellish, was an alternative to being told that they were a bank but operating without a bank charter, right? And so California, in its willingness to provide a license, provided an answer to that claim, a claim that had been raised both by the state of Louisiana and by the state of New York, if memory serves. And because it was somewhat a lower bar, and you could support other business operations through a money transmission license that you couldn't support if you had a bank charter. But this was at a time when California's Money Transmission Act only applied if you were operating and sending funds overseas. One. Two, at that point in time, California's Money Transmission Act actually preceded the development of what's known as the what was promulgated by the Institute for State Law Development, the Uniform Money Transmission Act. California's became an inspiration for the Uniform Money Transmission Act. And with the development of the Uniform Money Transmission Act and the application to all businesses involved in receiving money on a domestic basis, you saw the creation of a barrier to entry where one had not existed before. And I am familiar, both anecdotally and more anecdotally than anything, with the degree to which California's now adoption of significant capital requirements has led people to either go to states to test their products that don't have a licensing requirement, or to find somebody who's already a member of the club and to obtain permission to use their charter or their license to offer it. So, yeah. And that doesn't strike me as a positive development.
So I want to give Ms. Jung a chance if she wants to weigh in on this, because one side of the coin is consumer protection. Perhaps the other side of the coin is, at least in one dimension, barriers to entry. On the other hand, unreasonable barriers to entry means less competition, less choice for consumers, and presumably higher prices for consumers. I mean, certainly when we back in the 80s talked about airline deregulation and interstate trucking deregulation and all those, they were driven by much of this same kind of discussion and principle applied to different subjects. But I'm curious if you want to comment on this point.
Sure. I think there are a number of levels I can answer that question, but I think the first thing that I want to mention has to do with whether or not consumers would benefit from increased competition. One thing that comes to mind is the Durbin Amendment. Everybody said once interchange fees went down, merchants would pass on their reaped benefits to consumers. We have yet to see that happen. It may be too soon, but I highly doubt that will happen. So it's kind of the same case here. Merchants may be able to arrange for cheaper ways to process the payment, but it probably won't be reflected in terms of what is back in a consumer's pocket. The second point is what we've raised again and again is the point of this law is for consumer protection. We're not talking about making an application to see where your friend is instantaneously. We're talking about people's money. And for the most part, it's people who are unbanked and underbanked who are using these types of transmission services, and it will increasingly be so as the numbers have been very staggering as to the number of people who are using mobile devices to conduct every form of business, including payments. So the first and foremost, it would be that consumer protection should precede any other concern.
So, at least from your point of view, you don't see barriers to entry, at least in this endeavor, as adversely affecting consumers in terms of competition, because you don't believe they'll see the benefit of competition were there greater competition in this marketplace, and you're concerned about compromising other consumer protections. Is that the gist of how you're looking at it?
I mean, we don't sit nearly as closely as DFI in terms of the different inquiries and applications that they obtain, but there are companies that are newer, that are more innovative, who have been complying with the regulation and have acquired licenses and succeeded in doing so. So that does not appear to be a barrier of entry.
Mm-hmm. Okay.
Or barrier to entry.
Okay. And Mr. Mueller, I promised I'd come back, and you can certainly talk about this current question on the table if you want, but I'd also like to come back to your intriguing remark about some improvements that you think could be made in the statute, notwithstanding as I get it, your general satisfaction with the way it's operating with respect to PayPal.
So just to start on the competition point, we do see increased competition, certainly over the last 3 years. And I think certainly the regulations that the Commissioner mentioned will probably help. I think there's at least a perceived lack of clarity as to what the boundaries of the Act are. But I think we do see competitors who both build their business around what I would call more pure payment processing models, and are therefore able to stay outside of the regulation of the Act, and others who make that choice and have been able to get licensed. So companies in recent years like Facebook and Google who have been able to get licensed and start up their payments business, and smaller ones as well. So I think the regulations will help, and I think the competitive landscape for payments is certainly very vibrant, and more than ever. On the question about improvements that we see to the Act, again, trying not to get too technical, but Mr. Barnett mentioned the receipt and the right to refund wording. The right to refund, again, is premised on a delay in the transmission reaching the recipient, among other things. And in many cases, both through PayPal and through many of our competitors, the recipient knows right away that the funds have reached their account. So the wording, we do deliver a receipt. We don't have any problem with delivering a receipt to both sides of the transaction. It's simply a question of the specific wording that is mandated by the statute currently, which can be confusing to the sender and the receiver both. So that's one example. Another one relates to the way the statute deals with agency relationships, again, based largely on a model of traditional money remittance, where the Western Unions and MoneyGrams of the world work through stores and agents around the world. In our case, for instance, we're also trying to deliver more service and make online and mobile shopping more available now to underbanked, working with companies like a Coinstar and a MoneyGram. So if MoneyGram, which is itself, of course, a licensed company and has been for a long, long time, should they be treated as if they were just an agent or a corner store with respect to PayPal when PayPal and MoneyGram are working together? So we think there's opportunity there to make some changes to the act that can help clarify these new types of relationships.
Well, thank you. I think there's one other aspect of this competition issue or service issue that strikes me, and that's whether there are certain categories of consumers that aren't getting service that could or could get better service. So it's another aspect of this, but we'll leave that for another day to explore. Unless there are questions from other members.
Just watching the clock to see if we're going to bring it to an end because we have another commitment.
Right, that's what we're aiming at. So thank you all four. I appreciate your comments very much, and certainly as we look at trying to shape something productive out of the legislation I've introduced, I'm sure we'll be continuing this discussion with you and others.
Thank you.
Thanks.
Thank you. Thank you all again. And now we will take public testimony briefly. So if there are people here who would like to address the committee, we can do that now.
Is it at 3:45 or 4?
3:45, I believe. So if you could tell us who you are, and I know in at least one case we have a lengthy letter. We're going to need to keep your comments to a couple minutes, so I'll just let you know when you hit that marker.
Good afternoon.
Good afternoon.
My name is Aaron Greenspan. I'm the CEO of Think Computer Corporation, a startup in Palo Alto, and a Codex Fellow at Stanford Law School. There's no way I can fit everything I have to say about the MTA and AB 76 into a few minutes, but it's my hope that if you come away with anything from this hearing, it is the following, which is that with the MTA, we all lose. It is not difficult to see what I have lost. In 2009, I started working full-time on a mobile payments project called FaceCash. FaceCash's origins go back to my time at Harvard College, from which I graduated early with a degree in economics in 2004. As a freshman at Harvard, I enrolled in a seminar about facial recognition, and I later realized that some of the insights I gained from this course could be used to make payments safer. The patent on this technology will be granted tomorrow, as it turns out. So as everyone here surely knows, identity theft is an extremely serious problem. According to a recent Javelin report, identity thieves stole $54 billion in 2009. I'm sure it's higher now. Much of this can be attributed to the fact that the plastic payment card networks that we all use today are fundamentally insecure and for a number of reasons cannot be upgraded. The only way to make the network more secure is to build a new one, so that's what I set out to do. After a substantial investment of approximately $1 million of my own money, FaceCash went live in April 2010. It was shut down on June 30th, 2011 at the request of the California Department of Financial Institutions due to the new MTA. I tried to apply for a license, but at my mandatory pre-application interview, among other self-contradictory, ignorant, confusing, and false statements, Deputy Commissioner Venturuti personally threatened to call law enforcement officials with instructions to throw me in jail because he did not like the kinds of questions that I'd been asking him about the MTA. So I felt as though I had no choice but to abandon my investment, my product, and my employees. So that's what I lost. But again, with the MTA, we all lose. My employees lost their jobs, the state lost tax revenue, and this is all because the MTA is a protectionist law written solely for the purpose of preserving the monopoly power of the few financial institutions represented by the law's initial and sole sponsor, the Money Services Roundtable. The Roundtable's monopoly allows its members and banks who also benefit from the law to keep charging consumers outrageous prices for basic financial services whose actual marginal cost is near zero. When the MTA was proposed, it was described in terms of, quote, consumer protection. The same is now true, as we've been discussing, of AB 786. But the truth of the matter is that both the MTA and AB 786 harm consumers, and especially entrepreneurs. So do the Roundtable's members. One of them, MoneyGram, recently settled with the U.S. Department of Justice for $100 million over criminal charges filed regarding an even larger decade-long fraud. In effect, thanks to the money transmission laws like the MTA, consumers have been forced into the arms of corporate criminals because of these pointless barriers to entry based on this totally false premise that rich people are inherently more trustworthy. Another Roundtable member, Seagate Corporation, settled the DOJ in 2008 for $15 million for failing to comply with the Bank Secrecy Act requirements. Both are still licensed by the DFI. Perhaps this is why the DFI's own general counsel told me that he was personally appalled by the MTA. Today, Assembly Bill 786 only stands to make the presently bad situation far worse. In particular, the proposed new thought crime in AB 786, Section 2155, is completely outrageous and broadly interpreted would allow the DFI to lock me up in a federal prison just for having asked what the deputy commissioner considered to be the wrong questions a year and a half ago.
Mr. Greenspan, you're perfectly free to criticize the bill. I don't have a problem with that, but just I have a problem with time, and I've given you an extra minute because I know you have a lot to say. We will take your letter into account, but if you could, because we have an unforgiving time constraint, if there's one more thing you would like to say in summary, why don't you give that to us, and then I'm sure this conversation will go on.
I will give you the laundry list of why I believe the MTA should be repealed and is unconstitutional. And I say it should be repealed not because I'm a libertarian who hates regulation. I think there should be federal regulation of this, and I know that Congress is looking at it. But the states, I like your airline analogy from before. The states are not in a position to regulate internet transmissions. The courts have already said so. But aside from that, it doesn't make any sense. It's like having a different FAA in each state. It's incredibly dangerous.
Okay. Well, I know you've got more to say, but let's leave it there. That's a good one. Okay. Next.
Thank you. I'll try to be as quick as I can. My name is Ron Garrett.
Welcome.
Thank you. I sent a letter in to the public comments, which was not included in the public comments. It's 2 pages long. I'll read as much of it as I can before I run out of time. I'm here mainly in my capacity as a consumer whose interests the MTA is ostensibly designed to protect, but also as a software engineer, entrepreneur, and investor who has significant experience in digital security, technology, and financial systems. Since I'm claiming some domain expertise, let me provide my credentials. I hold a PhD in computer science and applications from Virginia Tech. I've had substantial industrial experience designing and implementing secure financial systems. I wrote the billing system for the original release of Google AdWords in September of 2000, and I subsequently designed and implemented the billing system for 2 other startups. In December of 2008, I launched an effort to start a company whose goal was to eliminate credit card fraud. The upshot of the story is that the company never got off the ground in large measure because of regulatory hurdles. It is because of this experience that I can definitively say that extant financial regulations in the United States in general and the California MTA in particular are doing more harm than good, at least when measured according to how well they can protect consumers from fraud. To back up this claim, let me tell you my story. The fundamental problem with all non-cash payment methods currently in use in the United States, which includes credit cards, checks, and debit cards, is that they are based on fundamentally insecure protocols designed in the 1950s. To conduct a transaction, a buyer must provide the seller with information, account number, expiration date, billing zip code, what have you. The exact nature and quantity of this information is not relevant. What matters is that the information is not bound to a particular transaction. It's reusable. This is the basis for all credit card fraud, and it cannot be fixed except by making a fundamental change to the protocol. With the advent of electronic commerce, the risk of a fraudster being caught has been reduced very nearly to zero, and the result, unsurprisingly, has been an epidemic of credit card fraud that we are all familiar with. There is a technological solution to this problem. It's called public key encryption, and I want to get into the details of that. You just have to take my word for it for now. That using PKE, it is possible to design protocols where the information provided by a buyer to conduct a transaction is strongly bound to that particular transaction and so cannot be reused. The adoption of this technology would completely solve the credit card fraud problem. And in the interest of time, I will just tell you that after 3 years, I gave up on this effort. And the last straw was exploring the possibility of getting a money transmitter license. That turned out, and the process turned out to be so expensive and time-consuming and unpredictable that I decided not to pursue it.
Okay, thank you. And I am informed that we did include your letter in the materials that were made available to the public. It was included in the It was included in the materials the committee members received, and it's on the committee's website. So. We have made it part of the record, and thank you.
Hi, I'll be brief and to the point. My name is Manuel Cosme. I'm the co-owner of Professional Small Business Services. We're one of the payroll providers that was discussed a little bit earlier. And I'm also the California chairperson for the National Federation of Independent Businesses.
Welcome.
So I thank you for this opportunity. As I understand it, there's, according to the statute, there's a $5,000 non-refundable license fee, okay? And there's a $500,000 minimum for a surety bond, right? Okay. We provide payroll services for small businesses. The average employees is about 4. That billing runs between $72 to $100 a month. And to require the payroll service bureaus to come up with those kind of funds doesn't make sense. The services we provide, is that in the statute, according to what I read, is that we issue executable checks. Those executable checks, when signed, becomes negotiable, but that's only signed by the owners. Okay, so I would like to see a little clarity on this law, so that there is a distinction between the services that we provide, which goes from the business owner directly to IRS or EDD, or those that perhaps take funds. What happened with this Sacramento, where the funds was actually sent to a trust fund, and then from there they paid the agencies, and there was a. By the way, the state of New York had a similar problem.
Well, the other firm was in New York that was a victim. So
that's exactly. Yeah. So, but there is a distinction between the small payroll service bureaus that are throughout the state of California, as opposed to those.
Right, and I certainly, by my comments, didn't mean to suggest that all payroll firms are anything like that. I mean, that's the aberration, to be sure.
Yeah, and so, quite a few comments were mentioned today, and I thought they were excellent. And I'm hoping that you take some of those into consideration, especially from the representative of ADP.
Okay.
All right.
Yes, thank you for all three very, very much. Appreciate your testimony. And if there's no one else who wishes to address the committee this afternoon, we are adjourned.